Hey there, this is Ron Sneller, investment advisor representative, and this is the second quarter market outlook brought to you by Brookstone Capital Management. It was a tough quarter for investors. All major asset classes of stocks and bonds were lower, and only commodity prices were higher. Much of the challenge in financial markets can be attributed to inflation continuing to run high. The Federal Reserve has begun raising interest rates, and the U.S. Treasury yield curve really looks different than it did even 3 months ago, with the biggest jumps in yields between the 2 to 3 year maturities. Historically, the Fed raises short-term interest rates up to where the 2-year yield is trading, but the yield curve is already inverted in some areas, suggesting a slowdown in growth and inflation is already underweight. While retail sales in the top left clip, they look very elevated, the personal savings rate that you see on the top right clip has already fully reversed back to the pre-pandemic levels. What's adding to uncertainty in markets and inflation is what's happening with oil. Prices are back to where they were in 2011 to 2014. This should incentivize an increase in production, and in the lower left clip, as you see, it does look like total rigs have started to climb. With changes in interest rates, including mortgage rates, rising home and car prices, and rising prices at the pump, consumer confidence has dropped sharply, which should lower aggregate demand, alleviating some inflationary pressures. Now, while it may not feel like it, there's a very strong offset to most of these negatives, including inflation. And it's very unique to the current economic environment relative to history. The unemployment rate is very low, and job openings are massive. Usually, if an economy was going to roll over, you would see a reduction in job openings and a rise in unemployment. Now, turning to stocks, historically, during periods of inflation, value stocks tend to outperform growth stocks. So consistent with that data, we've been broadly positive on value, specifically focusing on traditional high-quality dividend-paying stocks. Our baseline assumption was that the market was going to experience a correction of more than 10% this year. And then a negative 14% was a good baseline assumption. As we leave the first quarter, the market did drop 13%, just shy of the 14% average correction, before staging a rally to finish the quarter. Volatility spiked during the quarter, similar to other correction periods, but we are aware that we could go through 2 such periods this year, similarly to 2018 or the 2015 and early 2016 period. This has been the Market Watch for the second quarter 2022.